September 2008, a 158-year-old bank, Lehman Brothers, collapsed overnight. $600 billion in assets vanished. It was the largest bankruptcy in U.S. history. Millions lost jobs. Over 8.7 million Americans were unemployed by 2009 due to the crisis. Retirement savings wiped out. The stock market lost $7.4 trillion in value. This wasn't an accident. It didn't come out of nowhere. It started years earlier. With a lie so simple it could fit on a billboard. Why rent when you can own? Now back to the early 2000s. The US was still recovering from the 2001 dot-com crash and the 9/11 attacks. The economy was slow. To stimulate it, the Federal Reserve cut interest rates from 6.5% in 2000 to 1% by 2003. This made borrowing very cheap. People rushed to buy homes. Between 2000 and 2006, U.S. home prices rose by over 80%, but many of the people buying homes couldn't afford them. Between 2004 and 2006, more than 20% of all new mortgages were subprime, loans given to borrowers with poor credit. Some of these loans required no proof of income or employment. These were called NINJA loans, no income, no job, no assets. Banks didn't keep these loans. They sold them to investors. They bundled them into financial products called mortgage-backed securities, MBS. These bundles were then rated as safe by credit rating agencies. According to the U.S. Financial Crisis Inquiry Commission, more than $1.9 trillion in subprime MBS were issued between 2004 and 2007. To make more profit, Wall Street created complex products like collateralized debt obligations, CDOs. These were combinations of MBS, even riskier, and they were also rated AAA, the safest rating possible. According to the U.S. Senate, by 2008, over $640 billion worth of CDOs had been issued globally. Some investors began to notice the risk. They created insurance contracts called credit default swaps, CDS. These allowed them to bet against or short the housing market. By 2008, the value of outstanding CDS contracts reached $62 trillion, more than the GDP of every country on Earth combined. But the housing market was already cracking. Homeowners started missing payments. By 2007, nearly 1 in 5 subprime mortgages were delinquent or in foreclosure. Home values began to fall. The average U.S. home lost 33% of its value by 2011 compared to 2006. Then came the collapse. In September 2008, Lehman Brothers, a massive bank with $600 billion in assets, went bankrupt. It was seen as too big to fail, but it did. That same day, the Dow Jones dropped 777 points, the biggest single-day fall ever at the time. The S&P 500 also fell nearly 9%, its worst drop since 1987. Trillions in market value vanished in hours. Investors panicked. Banks froze. They stopped lending even to each other. Businesses couldn't get loans. Families couldn't borrow. The system froze. Jobs disappeared. In 1 year, 2.6 million Americans lost their jobs. Over 10 million people lost their homes. Retirement and college savings were wiped out. Spending slowed down. By 2009, unemployment hit 10%, the worst in 25 years. For many people, the system had failed and they were left behind. To prevent total collapse, the U.S. government passed a bailout. The Troubled Asset Relief Program, TARP, committed $700 billion to stabilize the banking sector. Major banks like Bank of America, Citigroup, and J.P. Morgan Chase received funds, but 6 million families would eventually lose their homes to foreclosure. This wasn't just a financial crisis, it was a global crisis. The U.S. economy didn't fully recover until 2014, 6 years later. Many of the same risk patterns are reappearing: high household debt, rising home prices, easy access to credit. In 2023, the average U.S. home price exceeded $400,000, up from $180,000 in 2021-2009. Mortgage debt hit $12.5 trillion, the highest in U.S. history. The 2008 crash began with one message: why rent when you can own? But behind that idea was a risky system, one that hurt millions. If you enjoyed watching this video, give this video a like, subscribe, and turn on the notification bell so you never miss any of our next videos.